Oil, rates, and AI are pulling portfolios in different directions as an emerging energy shock collides with resilient growth and hawkish central banks. Welcome to vTalkInsight, Allocators Lens Daily for July 22nd, 2026, where we connect the cross-asset dots that matter for capital allocation. Equities are again trading as if earnings and AI can outrun almost any macro headwind, even as bond yields grind higher and Middle East risks intensify. The S&P 500 just posted a solid gain with volatility still in the high teens, underscoring that risk appetite remains firm rather than euphoric. The core equity story is still about AI as a growth engine. Hyperscalers are projected to spend around $5.8 trillion on AI capital expenditure over the next 4 years, and backlog growth in cloud and compute remains strong, keeping pricing power elevated. Semiconductors sit at the center of that theme, but the ride has been volatile. Chip indices have swung from near bear market territory to single-session rallies above 5%, while companies report earnings growth in some cases close to doubling year-on-year, and export data, such as from South Korea, show demand in full ramp. Within tech, leadership is narrow but slowly broadening. Micron and NVIDIA are doing a disproportionate amount of work for S&P earnings this quarter, yet value stocks, financials, and even previously lagging markets like China, Indonesia, and Brazil are starting to contribute more to global equity performance. At the same time, positioning looks extended. Long-only equity exposure is approaching peak seen in the post-pandemic reopening phase. The momentum factor has just delivered one of its worst months in a decade, and hedge funds have been cutting tech exposure as crowded AI trades whipsaw. Options flow and retail behavior add to that stretch picture. Call buying is concentrated in chip stocks. Retail now accounts for roughly 30% of daily U.S. equity turnover. And even Bitcoin is seeing renewed institutional interest as exchange-traded funds move back to inflows and help keep prices above $66,000. Outside of pure tech, earnings breadth is improving, with banks, industrials, and autos like General Motors upgrading guidance and financials outperforming the main index by several hundred basis points. Yet some managers still flag the risk of a mid-single-digit to low double-digit equity pullback, especially if oil prices lurch toward $120 per barrel or higher bond yields start to bite into valuations. For equities, the key tests now are upcoming big tech earnings, hyperscaler capital expenditure signals, and whether the unfolding energy shock finally forces a reassessment of how much good news is already in the price. In rates, the message is that yields are high and could stay that way longer than many equity investors seem to be assuming. Short-dated Treasury yields have risen for 4 straight sessions, with the 2-year up more than 10 basis points as markets lean toward a renewed hiking cycle. Expectations are coalescing around the idea of roughly 3 Federal Reserve hikes later this year, with a first move discussed for early autumn. If that path materializes, current 2-year yields look too low, and term and inflation premia on longer maturities may still have room to rebuild. The driver is less about headline inflation prints and more about stickier components. Core non-shelter services inflation has shown little improvement over the past year, and non-shelter services are still running close to 4%, while energy and refined product prices are reintroducing upside risk just as the Middle East becomes more unstable. There is still a counter-narrative that policy is effectively on hold. Some economists expect rates to remain unchanged through 2026 if growth moderates and energy shocks prove temporary, but Fed officials continue to stress their commitment to a 2% target and a low bar for tightening if the data firm again. Outside the U.S., the UK gilt market shows how quickly fiscal and political uncertainty can feed into rate premia. Gilt yields have moved higher on talk of looser fiscal rules and increased defense spending. The spread over German bonds is historically wide, and markets remain sensitive to signs that already heavy public debt and external deficits could worsen. For allocators, the rates backdrop is one where bonds cannot be assumed to rally automatically if equities wobble, especially if AI-related investment and energy prices keep inflation pressures alive. Credit markets are still behaving like a carry trade more than a directional bet on spreads. With spreads already tight and little expectation of rapid rate cuts, the focus has shifted toward earning coupon income rather than hoping for big capital gains from lower yields. Since late 2021, High-yield bonds and leveraged loans have delivered returns north of 20 and 30% respectively, while broad investment-grade indices have been roughly flat. That divergence underlines how painful an overly defensive stance has been, but also how much risk premia in the more cyclical parts of credit have already been harvested. New supply is another theme. Barclays now expects higher corporate bond issuance, much of it linked to AI funding needs, adding duration and concentration risk at the top end of the investment-grade market, while private credit continues to grow in size and complexity as larger, higher-rated borrowers tap non-bank channels. Beneath the surface, dispersion is widening. Around $200 billion of debt now trades at distressed levels, with yields above 15% or prices below 90 cents on the dollar, and non-accrual rates in business development companies range from 0 to near high single digits, depending on underwriting quality. Credit has been more defensive than equities this year, but that apparent stability hides meaningful selection risk if growth disappoints or funding conditions tighten abruptly. In foreign exchange, the broad backdrop is still a firm dollar supported by U.S. growth, relatively high yields, and safe haven demand around geopolitical flashpoints. Higher U.S. real rates and talk of renewed Fed tightening reinforce that support, even as some investors question how much of the hiking story is already embedded. Idiosyncratic policy stories are adding localized risk premia. New tariffs on selected Canadian imports complicate North American supply chains and could weigh on the Canadian dollar, while UK fiscal uncertainty and talk of higher defense spending keeps sterling and the gilt curve sensitive to political headlines. Crypto is again acting as a high beta expression of risk sentiment alongside FX. After 8 weeks of outflows, Bitcoin exchange-traded funds have seen 2 weeks of net inflows, helping hold prices above $66,000 and signaling that some institutional capital is again comfortable adding exposure to the more speculative parts of the asset class. For currency allocators, the mix of a sturdy dollar and resurgent crypto interest reflects a world where policy and energy shocks are being balanced against strong U.S. growth rather than overwhelming it. Commodities, and energy in particular, remain the main transmission channel from geopolitics into the rest of the asset universe. Brent crude is trading above $90 per barrel as U.S. and Iranian forces exchange fire, and shipping through the Strait of Hormuz slows to a crawl, with some scenarios pointing to a spike toward $120 if the strait is effectively shut. The more acute stress, however, is in refined products rather than crude itself. Gasoline and diesel crack spreads are at or near record levels. Refining capacity is scarce, and inventories of key products are running low, just as the U.S. Strategic Reserve has already been heavily drawn down. Europe faces its own version of this problem through gas markets. Benchmark natural gas prices have moved to their highest levels since early spring, and with roughly a fifth of global liquefied natural gas flows transiting the Hormuz region, any escalation there would quickly tighten European balances and raise the risk of nonlinear price spikes. These moves matter directly for inflation and corporate margins. Gasoline prices have already risen sharply at the pump, restaurant meal costs are up double digits year on year, and companies report energy and commodity inputs squeezing profitability, especially in consumer-facing sectors. Against that backdrop, some large houses are tilting toward real assets and gold in their frameworks, reflecting a desire for inflation resilience as energy reasserts itself as a key macro swing factor. Across assets, the picture is a tug of war between powerful micro stories and a steadily tightening macro backdrop. Equities are leaning hard on AI-driven earnings and broader sector strength, even as rates markets edge toward a higher-for-longer outcome and credit quietly morphs into a pure carry trade with growing pockets of stress. A firm dollar, returning Bitcoin inflows, and an increasingly fragile energy complex round out a landscape where correlations can shift quickly if oil or services inflation surprise to the upside. For allocators, the key watch points now are big tech earnings and capex guidance, the evolution of Fed hike expectations, credit dispersion, and any further disruption to Middle East energy and shipping routes. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.